Hi traders, and welcome to my video on the only moving average strategy you will ever need. In this video, I'm just going to run through a very simple trading strategy that you can use. Okay, so this is the MT4 trading platform you see here. It's a euro dollar 1 hour chart. I've always preferred to trade higher chart time frames simply because they filter out a lot of the noise that you can get from the lower term chart time frames. So I like to look at the 1 hour, 4 hour, daily, weekly, monthly charts. This also means less time chart watching and the potential to capture big moves such as this one for over 400 pips. Okay, so what we're going to do is we're going to place the moving average indicator on the charts. We're going to set the period to 200. Okay, just make that line slightly thicker for you there. Right, so that's a simple moving average set to 200. Okay, 200 is one of the more popular moving averages, along with perhaps the 50. So if we just put a 50 on there as well, there you go. So we've got short-term moving average 50 and a longer-term moving average of 200. Just in case you don't know, the moving average is basically when price is below the moving average, we're looking for sell trades. When price is above the moving average, we're looking for buy trades. Okay, and that doesn't mean that you just buy every time price crosses above or crosses below, because you can see here, for instance, price goes above, below, you wouldn't be buying and selling every time. Instead, what we do is we look for a clear trend. Okay, and then once we find the trend, we can time our entry on a pullback to the moving averages. Okay, so how do we do that? Well, the first thing we need to do, we've got the moving averages on the chart. This 50 is optional from my perspective. I like to keep trading as simple as possible, not going to rely on any sort of overcomplicated indicators or just clutter our charts with a million different moving averages. Crossing over. I mean, this is the 50 and 200 cross. You can see this cross here of the 50 and 200 is this is known as a death cross. Okay, so it's quite significant when the 50 crosses the 200 below. It's a big sign of a bearish trend potentially starting. You can see it was true in this case. Just as when the 50 crosses above the 200 is known as the golden cross, which suggests the start of a strong bullish trend, as was the case here. This won't always be the case, which is again why I say we wait for a trend to form and then look to time our entry on a pullback and or a breakout. Okay, you can see this cross, for example, here, not so good, choppy market conditions. Same here with this cross. You know, we're in more of a consolidation around here. You want to wait for more of a clearer breakout like this here. Okay, so to time our entry, what we can do is, just to clarify, we're only going to sell or go short when price is below the moving averages. So going back to timing the entry, first what I do is I like to mark resistance. So I have resistance there. Okay, this is actually a triple top formation. As you can see, the resistance was tested at least 3 times. We have 1, 2, 3 times there. Okay, then we have our support level here. See, this is quite a strong level of support. It's been tested multiple times. Okay, but then the price starts to make these lower highs here. We just zoom in. This is the thing, when you use too many moving averages, it can just clutter your charts. But you know, you don't even necessarily need the moving averages just to gauge. You can just look and see the markets falling here. You can just use your eyes to see that. But we'll leave the moving averages on there. Okay, so what we're going to look for is price to be below both of these moving averages, and that happens around, well, it does happen here and here, but bearing in mind we've got this level of support. Okay, so we're going to first want price to break out from this level of support. Okay, and that's what happens around here. So price breaks out below the support, price is below the 50 and the 200 SMA. So we're anticipating a downtrend. So what do? We don't just jump in on this breakout. You can, if you like, jump out on this breakout here. However, we can wait for a pullback into a trend. Okay, we can see the lower highs here. Lower high, lower high. We've actually got some bearish candlestick patterns as well there, just to confirm this. And then when there's a pullback around here, we can draw our ledge, nice wedge formation there, and trade this breakout here. Okay, simple as that. And that's how we get into a trend as early as possible. Furthermore, if we bring back this support level, you'll see this is actually strong support as well. Okay, been tested bang on the button multiple times. So once price did eventually break through this level of support, there's plenty of momentum. Traders are watching these levels, as I said, 1 hour chart. These levels tend to be more reliable from my experience. And yeah, we can enter this trend, this big trend here on this breakout early. If you miss the initial entry, what you can do is you can wait for another pullback. What you don't want to do is, open your charts, see the price down here, get excited and sell, because you could end up selling at the low. Same here. If you see a big candle like this and you think, okay, great, I'm going to get in on this trend and sell there, you're selling at the low. You want to wait for a pullback. And this is where the 50 SMA can come in handy. You can wait for the price to pull back close to this moving average, for example here. Okay, you see the price pulls back, has a nice pullback, almost touches the 50 bang on the button. And what you can do in this instance is draw your support level and trade the breakout again there. You've got a nice M chart formation as well here. You've got your lower highs. Okay, got this wedge channel here. That's a descending triangle pattern. So you could have entered this breakout. This is actually an NFP, non-farmers payroll, first Friday of the month candle. This big candle you see here. So we could have used that momentum to hop in on this downwards trend. I mean, there was even opportunities to get in before then on the first pullback. After this breakout, okay, we had a pullback here. Price didn't quite reach the MA, but that's why I don't take moving averages as gospel. I mean, I can clearly see that the market is trending downwards. So I know I'm looking for a sell, and I'm going to time my sell by looking to trade on a breakout of support. Again, M formation, this support then becomes resistance. Okay, see, support, 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 support. Once there's a breakout, it then becomes resistance. Okay, no coincidence there. One could have traded that breakout as well. You see, you've got price ranging in this channel here. Okay. This resistance holds up well here. And then, yeah, we could have entered there. If we had not got in earlier, we can even get in there. Ample opportunities to enter in on this trend. So I say this is the only moving average strategy you'll ever need, because the moving average simply tells you the direction you're going to look to take trades. That's the longer term moving average, because we're trading with a longer term trend. Okay, whereas the shorter term moving average can help you identify areas of pullbacks. Okay, like here, for example, you can see price pulls back to the shorter term moving average. And then we're not buying there because we're still well below the longer term moving average. But what we can do is we can draw a level of support. Okay, obviously open to interpretation. Some people use candlestick bodies, some people use wicks, some use a combination of both. But as you can see, this level of support is tested multiple times. Breakout there, that support then becomes resistance. Okay, you've got, where are we? Here, this candlestick pattern here, this inverted hammer, the bearish signal. Okay, you've got 3 black crows as well there. Nice engulfing candle there. And of course, what's obvious is the lower highs as well. We don't need any fancy indicators to tell us how to pick trades or time our entry. I'm entering on breakouts on this particular trend. Some traders may actually enter on the pullback, so that when price comes back, they might just enter on the pullback and not wait for the breakout. The problem with that is price may not just be a pullback, it may be a complete change of trend direction, which is why stop loss is important. In talking of stop losses, I would place it in a downtrend. I place the stop loss at a recent high. So had we taken this breakout trade here, okay, the initial one, the initial move, my stop loss would have been just above this high here. So you're looking around 15 pips, which is a relatively tight stop loss on the 1 hour chart time frame. Okay, and that's good, because if we had our stop loss there, 15 pips, and this trade goes, you know, over, how much was that? And there's a potential of, you know, over 350 pips. That's a really, really good risk to reward ratio. And granted, you know, we're not going to exit right at the bottom, because how are we to know that, you know, that will be the time to exit? Well, what we can do is we can see when there are higher lows, that may signal a potential turnaround, and price crosses above the shorter term moving average, and more importantly approaches the longer term moving average. You can see it did here, it did actually reject it a few times until it crossed above. So this would have all been, once you see this choppy markets like that, you might consider it exiting the position anyway. But what I do, just to make life easier, going back quickly to the 15 pip stop loss, that's good, because if we're trying to pick the start of a new trend, it's okay to take a stop loss here and there. We can take a 15 pip stop loss 1, 2, 3, 4 times. Yeah, let's say we take 4 15 pip stop losses. That's what we're down 60 pips plus broker spreads and commissions, fees. 60 pips, okay, but we're not going to cry, because when we do capture a big move like this for 360 pips, we make back that 60 pip loss and 300 on top. Okay, that's why money management is important. You can have the best entry criteria in the world. If you've got poor money management, it's just not going to matter, is it? You know, if we've got like a, say we have a, every time a 50 pip stop loss and 100 pip take profit for no reason at all, just because we like those numbers, the stop loss is up around here. Doesn't need to be up around here. It can easily be above the high there. And 100 pip take profit would be around here, which is great. You know, still would have been a decent trade. However, you leave them way too much on the table, way too much on the table. You can re-enter, of course, but you run the risk of getting the trade wrong the more that you re-enter, and the more you'll have to pay in terms of broker commission fees. So instead, and same for the stop loss, you don't need to take a 50 pip stop loss. If price turns around and rejects, is there's a false breakout here, a fake out, you know, we can cut our losing trades short and just let our winning trades run. So in order to capture as much as possible of the move, I'm going to use a trailing stop and a break even. So what I don't want to do is I don't want to take this trade here, okay, and just leave my stop loss in the original position and just see how far it goes. Nope, instead I'm going to wait for price to drop, and once I see price drop around here, I'll move my stop loss to break even. Okay, because we don't want a winning trade to turn into a losing one. If price does turn around, we'll be taken out in a worst case scenario break even, but it just gives us that comfort and peace of mind that, you know, we've got the trade locked in, break even at worst case scenario, and we can just see how it plays out and potentially capture a big move. Then as price continues to fall, down here, we can continue to move our stop loss above the recent highs. So here and here, as it continues to drop, stop loss above the high, above the high, above the high, above the high, more or less all the way down. Just as price drops, stop loss above the high, above the high. And our last stop loss may have been above the high here, but we get taken out for the majority of the move. That's a nice big trade, one initial trade, hundreds of pips, profit potential, tight stop loss, sensible money management. You know, we're not going to trade out of FOMO, not going to get fear of missing out, open our chart when price is all the way down here and sell at the low because we think we're missing out when the trend's already happened. Okay, we're not going to revenge trade if we get taken out early. We don't just jump in out of anger. We don't get scared, fear, and exit early. We don't get greedy and just stay in too long. even when we see price turning around. Okay. And as I said, you can look for pullbacks. See here, pullback as well. You've actually got a nice M formation there, and the breakout to the downside. You could have took a trade there. Market making these lower highs all the time. Okay, lower highs, lower highs. Okay, trading breakouts. Again, as I said, you don't want to sell too low, but you can see this level of support holds up well as resistance. Could have been a cheeky trade towards the bottom there, but ideally we want to get in early around here. Cut losing trades short, let winning trades run, try and capture big moves like this. Again, the moving averages, the aspect of this is just the longer term one is to show you the direction we're going to look to trade. Short in this instance, or sell trades, and the shorter term can be a good area to gauge pullback. And to be fair, you don't actually need those moving averages, as ironic as that sounds considering the title. But you could just look at the chart and say, well, price is going down, let me time my entry. So yeah, that's how to trade this strategy in a short trend, a downwards trend. In a long trend, it's basically the same. So price above both. Okay, once you see this big breakout here, we don't get excited and panic. You certainly don't want to buy at the top of a move like that, because you will be buying at the top. You're going to want to wait for a pullback. And then you can see we have this level of resistance here, and then a nice breakout and a pullback even there. So could have taken this breakout, perhaps the more aggressive trade, got the market making these lower highs here. Okay. And breakout there. Whether you wanted to take the aggressive one, or if you were worried about a fake out, a fake breakout, you can always just wait for this little pullback there. Okay, and have entered there. Did have this candle, which is a bit of a spanner in the works, but nonetheless, we can see the trend continuation. Okay, and perhaps the more aggressive trade would have been around here somewhere. Okay, got a nice W formation there. Could have looked to have traded there. Some traders may have even drawn this resistance within here. See this resistance becomes support. So this was strong bullish accent, bullish signals, sorry. Got a 3 inside up candlestick pattern as well. Okay. Support there. As I said, this is a 1 hour chart. If you went to like a 50-minute, 5-minute chart, you'd probably see this is a lot more relevant, this level of resistance here. Same with this one. This is probably the safer trade, the safest trade, just because you've waited for the price to break away and then have a pullback after this, this choppy situation here and here. Okay, this is sort of when the trend just really breaks away here. So perhaps these are the more aggressive entries. You could potentially earn more, but slightly riskier, I'd say. When you have ample opportunity, again, it's just simple pullback, breakout, pullback, breakout. You don't, when price is too far away from the moving averages, you can see from this one, the longer term to here, you might be buying at the high, or if it was further away below, selling at the low. So you want them to be as close as possible, even here. Okay, you've got the lower highs, higher lows, sorry, resistance, and a nice breakout there. By then, the move's already gone plenty, so you don't want to buy at the top. You want to get in and around here somewhere, ideally. Okay, again, stop loss, let's just say we took this breakout. Okay, not as aggressive as in here. However, still a good trade to take. Stop loss below the low, around 20 pips, again, relatively tight for the 1 hour chart time frame, and around 200 pips profit potential once we see that the market is making these lower highs here, and you've got this consolidation. You can be thinking about exiting your position if you hadn't already via a trailing stop. If you had been putting your stop loss, as price moves up below the low, below the low, below the low, below the low, may have been taken out before, but nonetheless, still a good trade in the space of a week or two. Hundreds of pips of profit potential. Okay, so this is a really simple moving average strategy. You don't need hundreds of moving averages on your charts. You just need to be able to, you don't want to trade as well in choppiness like this. You see this? You zoom in. There's no clear trend. If the trend's not obvious, then I'd personally avoid, unless you're range trading, in which case this is not the video you want to be watching. I do have videos on range trading strategies, but as the saying goes, a trend is your friend. I prefer to trade in line with the overall trend and capture big moves, most importantly. Okay, you can see clearly in this picture the breakaway here, right? Okay, so had we been in real time and we waited for this breakaway there, would have been a nice trade and a good way to get in early on that significant downwards trend there, with other opportunities as well as we looked at on the way down. Just most importantly, good money management. That way, even if we're wrong, more than 50% of the time it doesn't matter, because we know that it just takes one of these big trend trades to make back any losses, and then some more on top. Okay. Moving average crossover as well, just to go back to the def crosses when the 50 crosses the 200 below, and the golden crosses when the 50 crosses the 200 above. I wouldn't trade that blindly personally. I would maybe look for them to be aligned that way, 50 below the 200, price below the 200 at least. But yeah, I wouldn't trade just when they cross over. I want to look at price action. A moving average crossover does tell you like the general direction of price up or down, but it will not tell you like price support, resistance, and stuff like this, which for me is just as important. And is more important actually. And I've removed the moving averages there just to show you don't actually need them, believe it or not. Some would argue the chart just looks a lot cleaner without, like, if we just remove these lines. Let's remove these lines for you there. I mean, if we just keep it as basic as possible. Okay. Support, resistance, market's trending down. That's it. That's all we really need to know. And we just need to time our entry. There you go. Okay. There you go. Support, breakout. Okay. Support, breakout. Okay, obviously support is open to interpretation, as I said. Some will draw it on an angle like this, some will draw it straight across. It just depends on your own preferences. But either way, there's ample opportunity to see support M pattern formation there. Support then becomes resistance, and you can trade either a pullback there to the support and resistance, or just wait for the breakout there of the next support level, which then becomes resistance itself. Okay, good money management, good discipline, no negative emotions, fear, anger, greed, revenge trading, FOMO, etc. Okay, hopefully you found something useful in this video. I do appreciate you watching. If you can like and subscribe, that would be great. I hope to catch you on the next one. Take care.